introduction and such an elicitation of my thing. So I come from a background where we have, even in workplace, I'm a very informal person. So these kind of formalities sometimes really goes above my head. So kindly excuse me. So this talk or speech or whatever you might like to call it as, I would like to keep it as informal as possible. I don't want to make it a monologue kind of thing. I may pause and ask some questions, not in terms of checking out, but just to find out the mood of people over here from that sense. So, how much time do we have? 30. Okay, so you can time because once I start, I will not stop. That's the problem. So, with that caveat, so that's why normally when I go to speak, I tell somebody to watch the time, and like in Pattimandram, they have 10-15 minutes. Somebody has to ring the bell. You got 25-10 minutes more.
We are also informal. We'll not tell you. We'll go.
Okay. So
the audience has questions.
Yeah. Okay. So without much ado, since 30-45 minutes you have given, so let me not take too much of time on introduction as such. So before I start, I just like to understand. I mean, it's like taking coal to Newcastle. All of us invest in some form or the other. We would have various forms of investment, and all of us are in the upper middle income or higher income. So to come and talk to them about investing is little I think. But nevertheless, having said that, I find that we don't do too much of investment in equities. So I would like to focus only on equities as such. Other forms of investment we can have a discussion maybe after that, or even during. You want any specific, I can share with you. So just to warm up people here, how many of you invest in equities? Hardly 10-15%. This is a little bit of shocking to me actually. It's a very elite audience. I expected at least 50, 60, 70 people would be in equities. So nevertheless, it's fine. So it gives you a great opportunity to speak, and even if I go wrong, you will not be able to point out. Okay. So from that perspective, it's fine. I just want to ask a simple question: as why are we not investing in equities? In fact, it's not a very pointed question. I'm just asking a general question, not necessarily to people who are not investing. Even for people who are investing, if you look at the investment market as such, except for the last 2 to 3 years, investment in equities is not considered even by elite audience like you as well. So this is a national phenomenon. It's not particular to this room alone. And if you really look at investment as such in equities, is hardly 3%. So large part of our investment goes in bank deposits, gold, real estate, and maybe traditional form of PF, medical insurance, and those kind of government bonds and securities. But investment in equities is only 3%. And it makes me wonder why are we not investing in equities? Can any of you who are not investing, can you say why you are not investing in equities?
We don't have money. We have suffered.
So, but you.
It's very volatile. Very volatile.
Okay. You said the tone. What did you say?
There is no right mentor for that.
Right mentor.
Okay. No, but mutual funds are there. Anyway, we'll get into that. Normally, if you look at fixed deposits, give you about 4 to 6%. Okay. And if you traditionally you take the last 30 years average, there will always be spikes. If you really look at, say, gold would have given about 8 to 10%. Then if you go to real estate, most of the people or almost everyone would have had real estate in some form or the other, either home, land or something like that. So if you look at, barring Kumar is a real estate guy, so you keep yourself out. But generally, what do you think would be the return on real estate over a last 30-year period? Even for you, it would be the same. Can any of you guess what would be the return on real estate?
Over which period you are talking?
30 years period. I'm saying it's an average I'm talking about. It'll
18,
always be
18 to 20%.
100%.
100%.
100 and 200%.
I'm saying over a 30-year period.
18 to
I'm saying
20%.
average returns.
8 to 10%.
No, no.
It's about maximum, even the best of the. That is the fallacy. I think this is exactly. I'm happy with the answer he has given. This is the perception. Real estate doesn't give you 100% return. Point A to point B is not the way you have to look at it. You have to look at the period of time, whether it is 10 years, 15. You started investing, say, 15 years back. Okay. You take your 15 years average and look at even the spikes of ups and downs. Even the best of it would not be more than 13%, barring maybe 1 or 2% here and there. It's a traditional. You can check up with any real estate investment over a period of 30 to 40 years. Wouldn't have given more than, I'm saying 13 is on the higher side, somewhere around 11 to 12%. You have to, on an annualized basis. When you say 100, you have to divide it by the number of years and you have to compound. So if you take that way, 11 to 13% is the real estate. Gold, I said 8 to 10%. Fixed deposit is 4 to 6%. And how much you think would be equities?
15, 16%.
Minimum 20%.
15.
No, again you have to look at 30-year period. I'm just saying it will be around anywhere from 15 to 18%.
15.
So if you really look at it, among all the investment class you look at it, it is about, you take on the lower end 15, on the higher end 18. 18% compounded is a big number. We underestimate the numbers because when we look at absolute numbers, but as finance experts, when you look at it, you have to divide it by the denominator and then you have to look at it. So it's a 15 to 18%. If you have done well in equities, you will get. It's reasonable kind of an expectation. Real estate is 12%, gold is 10%, fixed deposit is 4 to 6%, but you still don't invest in equities. This is the irony, and this is where the paradox comes in. Gold is something traditionally, historically, we have already been tuned. That is our genetic code. It comes from last 100, 200 years of our. Gold is the first preferred form of investment, and then real estate. But if you look at equity, is a phenomenon of last 30 to 40 years. The BSE started in 1980, so it's about 40, 45 years. But average would be around 20 to 25 years is the equity market in India, and the best period would be last 15, 20 years you can take. So if you look at that, here is an investment class which gives you 15 to 18% return. Now let's come back to your other investment class. In gold, liquidity is easy. Tomorrow you want to get the money, you can go and sell it. Storage is a problem, but it's still okay. It's not an issue. Liquidity is very high. Transaction is very easy. You want to go and buy, you want to sell, it's completely easy. So gold I can understand. It's a class which makes convenience as such. And historically, a lot of people had surplus money and probably accounting was a problem. They used to go in gold and keep it in gold historically. And it was also a kind of against inflation, it was hedging us. But if you look at what would be the average inflation rate in India, take again the last 15, 20 years.
5 to 6%.
Must be more than that, because when we say inflation, sometimes we get misread. What is your inflation? It's not Bijli, Pani and whatever it is, because we have certain categories. So basic needs are there. I think we have moved away from basic needs. So we also have the other strata. For an average, say middle and upper middle income people, it's close to 10%, 8 to 10%.
7 to 8.
Maybe at the lower level it would be 5 because they are only, large part of their income goes in consumption. So which will be about that 5 to 6% you are talking about, which could be even slightly higher. But for a class like us, it will be about 8 to 10% is average inflation. If I'm getting an average inflation of 10% and my return is giving you 10%, net it is 0. So your return is not even covering inflation. But still we prefer these forms of investment and we are very comfortable with that. Now let me come to the real estate parts. Real estate, what is the real estate? Historically it has always been very it has been growing. But if you look at real estate in terms of, real estate has to be divided into two parts. One is the land and one is the building. So land, undiscovered places, remote places we used to buy. Grandfather would have bought some 10, 20 years back, and after 15 years it becomes a pot of gold, and today it was a cost. That's how, even there it was the 13% I'm talking about. Even there when when your grandfather bought and you have got it, and you take a 20 to 30 year period, even there, by and large, your return would be only 10 to 12% is what you have got. But if you take, so you're buying a flat, what do you think would be a return on your flat? Normal, historically, I mean, even if you take last 10, 15 years,
3 to 4%.
you get 2% for your rental yield, and the building value is zero, it only comes down. It's a discovered place. So your actually will not be more than 5 to 6% or 7% maximum. So your flat which you're staying or the ownership is 7%. If you're buying a land, it is 10 to 12%. And but still all of us try to go into real estate. So I'm not against real estate, but I'm just saying it's a natural tendency. When we have surplus money, either put the money in gold or put the money in real estate. But real estate, as I told you. Now what are the pluses and minuses of real estate? Real estate, you close your eyes after 15 years, 20 years, if you have a land and it's a newly discovered place, it goes up and then you are able to do that. But the lot of liquidity, tomorrow you want the money. Of course, there are pockets you can mortgage and take it, but it's still not, if you want to dispose it of, it is not easy. In fact, I've been personally experiencing, my father-in-law passed away last 1 year, only 2 properties have been managed to sell. It may be out of my ignorance or I'm not so good at it, but nevertheless there is a challenge in selling real estate. Real estate has its own set of challenges. First you have to find a buyer, then the buyer will have a lot of documentation, which is again a problem, and then you have white and black and all this kind of stuff. You don't know what to do, and then execution you have to come. The amount of time it takes and the amount of effort it takes to consummate a transaction on a real estate is really mind-boggling. For people in the real estate business, it's a day-to-day activity. But for people like us, professionals, or even people who are having different activities, if real estate is a mode of your investment, it's seldom you will find it so convenient to operate. But nevertheless, all of us have to have a liking. So it's an illiquid instrument. I will not say completely illiquid, semi-liquid I can put it as, but it is not there. So, but we still, all of us have real estate, and large part of our savings, even without asking you, I can say that must be in real estate or close to gold. But there comes the third class, which is called as the equities. Equities, I told you, it is a 15 to 18% return on I'm only going on the index basis. I'm just going on index what it was at 1980, and or even take last 15-20 years, you will get at least 15% minimum, and on stocks you can go up to, but individually you can be plus and minus, but I'm taking over a period of time, 18% is a good return, 15 to 18%. Now let me look at what are the advantages of advantages and disadvantages of equity. In advantages of equity is that tomorrow morning you can sell, in next 24 hours you can get your money. Okay, liquidity is extremely high. There's no called as physical storage. It's all now digital. Everything is there. So it is, in terms of convenience of having it, there is absolutely no problem. Transaction is very easy. Transaction cost is very minimal. You pay 0.1% or 0.2% is your transaction cost. So transaction cost is easy. Convenience is there, but nevertheless, we find that percentage is only 3% of our population is investing in equities. So this kind of a misnomer, I mean this is a big difference which is happening in India, but large part of it is getting corrected in the last 2-3 years, but it will take another decade or so people come to. If you go to really evolved economies like say US or UK, the numbers will be completely different. What we are talking about, 3% investment in equities, I'm sure that class of people who can afford, will be around 20 to 25% will be in equities. So we are only at 3%. The question now I want to ask this audience is that, why is there so much of bias against equity? Somebody told, I don't understand. Fair point. Somebody says that I've lost money. Somebody has said I've lost money, so I don't like this class. Somebody said that I don't understand, so I don't invest in it. But for investment, there are mutual funds, there are professionals who are doing it. So I think that argument of yours, I don't understand, is also not completely valid. Maybe 5-10 years back, but today you have professional fund managers who are able to take care of that. Even in mutual funds, you will get about 12 to 14%. You will definitely get in mutual fund also. So, but nevertheless, we are not going there. So the question is that an evolved audience, affluent audience or class is still not investing in equities. So this is something we need to explore and see that why it is not happening and what is holding back. So the purpose of my talk, I really want to revolve around that because, and I'm very happy in that sense that the large part of the audience is not very much deeply ingrained in equities. So I'm a flag bearer for equities. So please, there will be a lot of bias towards equities. So some part of it you need to calibrate because I'm a hardcore equity guy. So sometimes when people come and profess their passion, certain amount of discount should be given. So with that caveat, I will start this. So if you look at, this has been a period, in fact it's a golden period for Indian equities in the last 10-20 years. If you look at it, we have grown. But still people are not getting into it because the fear of failure. The first thing is that, I'll tell you my reading why people don't get into equities. You buy a real estate also, there have been downslide. 99 there was a problem, 2008 there was a problem, 2015-16 there was a problem. So even in real estate, it's not that every year the real estate goes. Real estate will go for 7-8 years, there will be a slump or it will be at the same level and suddenly there will be another spurt. This 10-12% I'm talking about happens that it's not every year it is going by 12%. It's only when the jump happens that 12%. Otherwise, some people who bought at point A and point B is 2-3 years, in fact it could be even negative actually. I'm telling over a period of time. But still, why people could choose real estate is that there is no ticker which comes every minute. The problem with equities is that you start seeing your stock and value every second it is coming on the flash and every time you keep looking at it. So 100 rupees I bought and it comes to 98, oh I lost 2%. It comes to 90, oh I lost 10%. 110 it goes 10%. So this kind of volatility of highs and lows disturbs the people, a lot of people it disturbs. The peace of mind it disturbs and suddenly when they feel that that money they have lost, it's again a notional loss. The first fundamental principle in equities, I always advise people is that don't go for the money you try to invest in equities should be at least a 3-year time frame. You should not look at, I put the money today and I want to reap it tomorrow, or some people come and tell me that, sir, can I get monthly, like my salary can I get from that? That is not the case. It's not like fixed deposit you put and you get that interest becomes a month. It doesn't work that way. So you have to have a reasonable time frame of 3 years. The higher it is, the better it is. So, but at least a minimum 3 years. That is point number one. So people don't have those kind of time. They have those time frame because fixed deposit is there, which is many times it's a 3-year deposit. People put even 5-year deposit. I've seen people putting in. But the 3 years and 5 years deposit, if you ask them to put in equities, many of them don't do that for all the reasons we have said. The only reason is that your fixed deposit is not going down, or you don't presume it is not going, it's going down. And as a result of which you are okay with it. Your real estate is also not showing it is going down, so you're okay with that. The moment you start seeing equity every minute it is going up and down, that disturbance and the volatility really disturbs for people for getting it. So this is one of the major reasons I find there is a resistance, besides all the knowledge quotient and other thing which will come later. This happens primarily because of this reporting. And that is why if you go to mutual fund, to a large extent you may not have that issue which is confronting you, but nevertheless that is one issue. I'm very happy Neha is there. I think I would, my view is that you should teach this in school. Actually, we are at 60 years coming and trying to listen what is equities and what investment we have to do. In fact, they should have a session maybe at 8th standard, 9th standard or around that period on investment, because these are real life skills. Eventually at the end of the day you go earn, you have to do your investment. It has to be properly groomed at the right thing. But so this is one of the major reason why equities, I find there is a big resistance for people to get in. The moment you shut your mind on that, so now the question is that, now I'll rephrase the question now. First we said we are not interested or we are not doing equity. Now, what percentage, if suppose somebody tells you tomorrow, fixed deposit is 4% to 6%, all that I told you, 6 and 8 and 12. Now, if I say somebody, forget about all the problems which I told in the equity, 18% or 15% return I'll give you compared to the other instruments, I'm sure all of you would like to have that kind of a product. Okay, we'll say that. So now the question is that how much should I invest? This is the next question. The question people ask is that how much should I invest? Okay, now I'm convinced that if this gives me the highest return, then it is logical for me to invest maximum into this product which gives me the maximum return. Now the next question is that how much I should invest? This is another problem which happens. Normally what I would suggest is that whatever money you require for next 3 years, whatever your annual expenses which are there, multiply monthly into 3 years, plus some contingency for your what I call in terms of whether you have education for your children or for medical purpose, all that you keep that amount of money, please don't bring that into equity. The most important thing is that some of the people who make mistakes is also here. Some people put their vital money into the equities and then they find the next 3 months the price has come down by 10 to 15%. Then they feel that because I've lost everything or it's not going, I thought I'll make 18%, I'm getting minus 15%, so I should not. So the first principle is that money which you don't require for next 3 years, next 3 to 4 years, you please, that is the money you have to invest in equity, not the money you require in the next 3 years. If you have certain requirements, that money please don't bring into equity and then don't blame the product saying that this is a bad product, I brought in the money, I lost the money. So in fact, this gives me a thing, we all retired in the year 2021, we are all 61 born, 60 years. Most of my batchmates in school, all of us are in that 61, 62 batch. So one of he's not there, he's also one of the Lion member here. So I told him he also retired in 2020 December, I think, 2021. I retired in 2021. So I told him that how much of money you have in fixed. He's a very close friend of mine, so I could take the liberty of asking him. I mean, I can't go and ask everybody how much money you got. Please tell me how much you. It's a very close friend, so I asked him how much. He said some X amount of lakhs I have got in fixed deposits. So I told him next 3 years. Do you require this money? He said, I don't require this money for next 3 years. I may require after 4 or 5 years for medical and other. But 3 years I don't require this money. I said, please bring and I'll tell you one stock, you put the money in that stock. So this was a stock called ITC. So ITC I told him to buy 3 years back. So that time ITC for 5 years has not, stock didn't move up at all. 2015-16 till 2020, it was almost at the same. The logic was not on the stock. The decision I took was based on, it was giving a 12 rupee dividend on a 200 rupee stock, which was a 6% dividend yield. That time the bank interest rate was only 4-5%. Now the interest rates have gone up, bank deposit rates have gone up. So that time it was only 4%. I said, forget about the price. You don't require the money for next 3 years, right? He said, no, I don't require the money for next 3 years. So I said, you're getting 4%. Just concentrate on the dividend yield versus the interest return which you're getting on the bank. Bank is giving you 4%. This is giving you 6%. In 3 years' time, there's a very high possibility the share will definitely, at least your cost price will be protected. Even assuming next 3 years it doesn't go up, your cost price will be protected and you'll still get 6% return vis-a-vis the 4%. This is the very basic return, basic thing which I told him. As luck would have it, in 1 year time, the stock which didn't move for 5 years, in 2 years, from 200 went to 350, today it is 450, it went to 400, 500 and came back. So almost, he's not only doubled his money, more than double he has made, and it's not the wisdom of mine. What I'm only trying to say is that when you have a reasonably long periods of time and your alternate return is not high, then it's a no-brainer to move your money into equities. This was a simple logic. It was not any great foresight or vision. Not only this stock, there would have been many other stocks also we could have recommended. So that was the call we took, and it really paid off. So the other important question, most of the people make a mistake, is that when somebody, I ask them, what is the return you expect from equity? What would be your expectation? What return you want from equity?
20%.
So you are a very balanced guy, you want 20%. Some people come and tell me, give me 40%, give me 60%. I said, this is not a casino or something like that. You go there, you put 100 rupees, it will become 160 rupees. It doesn't. He's asking 20% because he's been a long period of time. He has seen the ups and downs. He knows that over a period of time he'll make. But generally when people come in, they say that we want 40%, 50%. Then you should go to casino. This is equity is not a place for making 60% return. So you have to have a realistic expectation. As I said that, what is your alternative thing? Your alternative, I'm leaving the business class out. Business class, obviously they'll say that if I put this money, I get 20% return. So you please put the money in your business where you are in control of it. So surplus money, we are discussing about it. If it is giving you 18% or 15% return, your fixed deposit is giving 4% or even 6% you take, your gold is giving 8%. When an investment is giving you 15%, why you want 40%? The question is that when you start looking at unrealistic expectation, when you have unrealistic expectation, you will take a very high risk you will take. The question is that always go, in fact, one cricket analogy I have to give you is that when Dhoni goes to, when he's the captain, when normally they ask him, what is the score? He says, no, I will decide as the game progresses. I cannot decide 300 runs I have to score on a 50-over match or 280. He says that we will start, we will see along the way, and then as the time works out, I will calibrate my score. Same thing is true in equity also. So when you're coming into the market, don't go with very unrealistic expectation. I want to make 30% return, I want to make 20% return. If it happens, you are lucky. But go with a realistic kind of a scenario. I want a 15. You start with 12%. No, I'm saying because your alternative, the way you have to analyze risk as a financial expert, what you have to do it. I have three, four streams of returns I have to get, and I have 3-4 streams of risks I have got. So I have to find a risk-adjusted return because each class has a different risk profile. So if you're saying that the previous one is 12%, which has a similar risk, in my view, real estate has a similar risk. Like, in fact, in my view, I'm a little biased towards real estate. I think the real estate risk is far greater than equity risk I consider. So if you are willing to stay there at 12%, 15% is good enough, no 2-3% more. So when you have these kind of realistic expectation, you can calibrate your kind of a stock picking on that basis, because risk and reward go together. The second thing first people ask is that, give me a multi-bagger idea. I said, if I know that, I will only be doing that. No, why will I be sitting over there and trying to find out which stock, which will work? I mean, we have groups that say, please give me some. I said, what do you mean by multi-bagger idea? No, it should be some 10 times, 8 times. I said, boss, if I know that is 8 and 10 times, I would sell all my assets and put the money over there. It's natural, no? So it doesn't work that way. The multi-baggers, when they call about, it doesn't happen. Multi-baggers happen along the way. In fact, multi-baggers, when you call that, it doesn't happen. It happens along the way, and when you continue, and when you are doing that 18% return itself is a multi-bagger. Because what happens, 72 divided by 18, your money will double in 4 years. 100 rupee becomes 200 rupees in 4 years. What is wrong with that? I'm saying 100 rupee in 4 years, somebody gives you 100 rupee today and you give, and somebody gives you 200 rupees at the end of 4 years. I mean, you should not be happy because you are getting 16 to 20 rupees in your fixed deposit. So 18% itself is a compounded return. I mean, it itself is a multi-bagger. In fact, Rakesh Jhunjhunwala, one of the doyens in the industry, he says, boss, anyway, if I get anywhere from 15 to 18%, he says, I'm extremely happy. You know, the background of Rakesh Jhunjhunwala came with 5,000 rupees in Bombay Stock Exchange in 80s. So 5,000 you can equate it to, but from 5,000, whatever is $5 billion they keep talking about, all happened only through that. In fact, I'm just digressing a bit. He used to come to our office, he used to sit outside. And those days we used to have physical shares, he used to sit and do that. So the question in equities is that have a realistic expectation and calibrate your risks according to that expectation. And there are many ways of picking up. The second thing is that somebody told, I don't understand equities. You don't really have to understand equities. I'm saying Warren Buffett, one of the doyens in the industry, says that this is the only place you don't require a very high IQ. People think that if you have very high IQ is what people have, very high knowledge is what people make a lot of money in equities. It's exactly the opposite. People have a lot of intelligence, but they still don't make a lot of money. The money comes through your attitude. The attitude which you bring to the table is your patience, is your perseverance. You stick. It is like, I normally tell that I have a relationship with each stock I deal with. I have 20 stocks, let's say I have a lot of stocks, but let's say 20 stocks if I pick up. I have a one-to-one relationship with each of the stocks. You may say, what? How can you have a relationship with the stock? It is like a face, it's like Manohar for me. One particular stock, if you sit with that stock, you know what are the nuances of the stock. So how the stock will move up, what is the background of the company, what are they doing, and this stock has to be dealt with only this particular way. So to give an example, I think one of Hindustan Petroleum member is sitting over here. In 2004, I bought a stock called as HPCL. Even today it is there. This stock used to be around 200 to 250 rupees. It used to go to 250, then you go to 300, then you come back to 200, to 22. It was doing like this. For 3 years I was sitting on it at 200, I was sitting only at 200 or 240. Then I realized something is missing. The company is doing very well. I'll come back to how the markets operate. The company is doing reasonably well. The prices are controlled by the government. The government is controlling I'm talking about 2004-06. They used to give oil bonds at the end of every year. The government, because the oil prices crossed $100 per barrel, so they had, the government had to control the prices. They were only giving 60, 70 was what the consumers were getting. The rest of it was oil bonds. So company was not making any money. But at the end of the year, just to cover the losses, they used to give the oil bonds. So this stock used to be at 200 to 300. This is what this stock used to be. I mean, if I'm wrong, you please correct me. So then I realized after a couple of years, there is a 200, there is a 300. I think 200 to 300 is a 50% jump. So I then realized that, why can't I do a trade between 200 to 300? So 200, 220 it will come, 260 it will go, or 270. I used to make a 15 to 20% return. I used to buy at 220, at 270 I used to sell, then it will come back to 220, I'll again buy it at 220, again goes to 260, 270, I'll sell. In a year I used to do 2 trades. 2 trades in a year, 15 to 18% into 6 months gap, gave me a 25 to 30% return. Same stock, 30% return. Then they used to government used to pull out money for dividends. They used to give a good dividend yield. So average I was getting 20, 22% IRR I was making, around that region, 15 to 3 years I lost out. Then I thought, this is the way this stock has to be played. So all the PSU stocks of oil companies, IOC, BPCL, HPCL, I changed my strategy. So this is a relationship I'm talking about each stock. So there you will find, when you start loving those, I'm not using the word in the negative sense of loving the stock, when you get into the nuances of the stock, you understand how the money can be made in each of the stock. The general principle, what people say is that, Warren Buffett principle, it's like a hero Honda, fill it and shut it and forget it. Indian markets, it doesn't work like that. There are a lot of companies, you fill it and shut it and forget it, you have to forget it only. In fact, go back, after 15 years also, you'll see the same price. There are a lot of companies. But there are a lot of events which happen during that period. So if you are able to understand the nuances of each of the stocks, and you know how this stock validates, and this company, now the story, I fast forward of HPCL. HPCL went in 2015, oil prices again came down to 40 also it came down to 30 also for a brief period. It came from 100, 150, it came down to 40 to 60. So this was the time for the government to give back to those companies. There's nothing wrong with the company. Company is doing exceptionally well, but price is controlled by the government. So now those companies also have to capex and other things, they have to grow. Unless you give them profits, they will never be able to reinvest. So the prices, you believe, this 300 rupee stock, which I said 200 to 300 rupees, 100 rupee movement in 15 years or 10 years, in 2 years went up by 5 times. The 300 rupee stock is 1500 rupee stock after adjusting for bonus and other things. So if you have stayed in that company, it's a stock I still hold. Even the same government is doing the same policy again and I'm playing the same game again. The question is that, what is your relationship with the stock? And each stock has its flavor. Similarly, if you look at Reliance Industry for 10 years, from 2007 to 2017, for 10 years it was at the same price, same strategy. Then 2017 to 2022, it went up by 5 times. So there are always a good company. The problem is, this is another reason why people don't like equities. The question is that there was one of my friend was there. He kept Hindustan Lever at 200 rupees, 200 to 250 from 2004 to 2010. 6 years he kept. It was the same price, whatever nominal dividend they were getting, he was enjoying with it. He sold the stock. Believe it or not, in 2 years' time, it went almost 2 to 3 years' time, 7-8 times it went. He said, "Was the stock was waiting for me to sell this after I sold." Next day onwards, it started happening. In fact, some of my friends said that the stock was waiting for me to sell. Yeah, after that, it started going for 10 years. I was holding. I was not making anything. So the question is that it is a one. There are two fundamental principles over there. One is that you make money only. It is like a relationship. It's like a husband and wife relationship, or whatever compatible relationship you have, you also have to have with the stocks, because if you understand the nuances of how these stocks behave, you will make money. Good companies I'm talking about, not about the run of the mill, the promoters cheating and running away. I'm not talking about those kind of companies. That's something you have to be wary of, which I can always share with you. But there are finer nuances of each of the stock, and those kind of identification happens only when you live with that stock and you breathe with it. I'm using very extreme terms of breathing and all. I'm just saying, if you're there in the market, it's like Sachin Tendulkar going day in and day out batting. He knows what the pitch is. You have to play as per the pitch. Whether you take ones or twos, or whether you go for fours or sixes, depends on the pitch. So even in a bad pitch, a good batsman still stays over there, and a time comes when he can score. Same thing happens in the market. And the gravest mistake most of the people do is that once they sell the stock, they will never buy that stock again. That's another cardinal mistake. For example, the same example I'm giving. Somebody was there in Hindustan Lever example I gave you. My friend sold it in 2010 at 250. Now somebody is entering the market just then, and he gets the 200 to 300, 300 to 400 it goes. That fellow is making money in 1 year time. My friend who stayed for 10 years made no money at all. So the mistake we generally do is that once we sell a stock, we don't touch the stock, because I have seen the stock at 200, 300. I went and sold it at 300. Why will I buy it back at 350? That's another mistake. These are some of the cardinal mistakes. So it is like one of my friends used to tell me, boss, in stock market there is no past. It is only present and future. Past, if you start looking at, you will make mistakes in the present. Because what happened is that I saw that stock at 200, or I lived with that stock at 200, I sold the stock at whatever price, now the stock has gone up by 20% up. Will you go and buy that stock? 9 out of 10 people will never buy that stock again. Because they have seen the stock, they feel that they have lost the opportunity. It was a bad luck on them for having sold that stock at a wrong time, and that is the price I have to pay. You don't have to pay any price. Today's reality, you think yourself, yesterday you wipe out and say that Hindustan Lever today is 220 and I think it is going up, you go and invest a percent. So the question is that when you exit the stock, you have to re-enter the stock. So it's like first innings and second innings. First innings you played, you scored some runs, and then you got out think as a second innings and a new person coming and playing the stock again. So the fundamental mistakes people make is sometimes you are too enamored by the stock, you don't want to give up that stock. And the other cardinal mistake is that people never book profits. There are a lot of people who never book profits at all. They think that some of my friends are there here, I don't want to name any of them. They buy, they say that this will go to 450, that will go to 500, I'll wait till 500. It has happened to me also. I was in Kotak actually, so we used to have ESOPs, so I used to get ESOPs. So generally what I used to do is that I had a price, I think 1,000 or something was the price I was. It's a target, my mental mind was at 1,000 rupees I will sell. I exercised my ESOP, it was around 800 or 900, I thought 10% more, 1,000. It went tantalizingly close to 1,000. 995, 98 also it went. I didn't sell. I was waiting for the 2 rupees. 1,000 comes, I will sell. Believe it or not, next 1 year it didn't happen. It didn't happen for 1 year. So then I realized that market is not waiting for me. I have to play as per the market. I am thinking that market is waiting for 1,000 rupees. It goes by itself. So then what I suggested is that you take kind of a calibrated kind of a move. I'll sell, if 100 is there, 20 I'll sell now, 25 I'll sell now, you will get an average price. So if you want 1,000 or the number I'm giving, you spread it over a small quantities over a reasonable large period of time, you will still get the average. But trying to, many times we think we are all great people, we want to buy at the lowest point and we want to sell at the highest point. You must be a magician if it happens all the time. Sometimes it would have happened 1 out of 100 times it will happen, and then you think that happened. So I want to catch at the bottom and I want to sell at the top. If that happens, it doesn't even happen to Warren Buffett, so there's no way it will happen to us. So the question is that please don't look at bottom and top. Always look at the average. So I always believe in average people making extraordinary thing. Even in organizations, if you really look at it, it's average people who hold the organizations. So your investments also, always, one of my person said that, how do you look at when the stock you sold goes up by 10% tomorrow? How would you feel? I'm just asking some of the people who are there in the market. You are selling the stock today at 100 rupees and tomorrow it goes to 110. What is your mindset?
The profit.
You already booked 100. You booked the profit. 110 the market price goes. You say that if I held on for another.
I said 10%, 15%.
But if you sold everything.
I mean, that's not a way.
Buy again.
That's not way.
That I will buy. 9 out of 10 people don't do this, Mahendra. That people don't do this because what they think is that I bought it at 100, I sold it at 100. It's my fate that I lost that money at 100. I mean, opportunity loss I've lost. They will know. 9 out of 10 people don't do that. So that's another mistake. So go and buy it. It's like a second innings. So the question is that fundamentally, when you are looking at I'm talking about strategies, what you try and do that. Then a lot of people say that it is like I don't understand finance. The most of the people what they say is that is something is above my head. I think in school somewhere either we are not good in maths or we are not good in accounts. Somewhere accounts becomes a mental block to some of them, not for all, but for some of them. This finance I don't understand. So the stock market means finance. I don't think that is also not true. Absolutely not true. I think ordinary people. It is like let me tell one more example. Real life, not an example. You're going to find a bridegroom for your daughter. What will you look at in the bridegroom? Is he working in a good company? Whether he is earning a decent salary? About his conduct, whether his habits and other things are good, and other matching which is there. The same simple. This is a simple thing which you do for picking today, even for bride or bridegroom, you do the same thing. So same thing is true in stocks as well. What you have to do is that fundamentally look at what is this company, who are the promoters of the company. This doesn't require any rocket science that I need to do intense research. Nothing is required. Today everything is available on Google. You just find out what the promoter is doing. If it's a good group, you don't even have to do. If it's a Tata's or good group companies, you don't have to do. Even assuming those kind, you can go and check up about the promoter. Is there anything wrong about the promoter? It's very easy. It's not so difficult. Next is that I don't know to read balance sheets. So how will I know what that? There are only 3 things. I used to when I went to Adi Godrej's office once. So he wrote one thing. He said revenue is vanity, profit is sanity, cash flow is reality. So when you look at the company, you don't have to go into too many details. You don't go. Just look at 2 or 3 fundamentals. That is also very easy. If you know to read and write, you can be able to do that. Just go and see what the company has made profit or not. That's a basic. You have to look at the balance sheet. That's only one number, one line item I'm talking about. The profit or not. Profit is there. Then okay, profit is there. Then what else is there? Is the company paying taxes? Because a lot of companies, what they do is that they book revenues which are not real revenues. They'll just fake revenues they'll book, and they'll book fake profits also they book because they want to play in the stock market. So fundamental 2-3 things you look at, some of it you can eliminate. You look at the cash flows. There is a cash flow statement which each company gives. It's mandatory now as per the guideline. You look at only 2-3 things you look at. Just go to the balance sheet, or even you can go on the Google and find out what is the cash flow of this company. This year, how much has he made real cash flows? If he's made cash flows, out of the operating activities. There are three things: investing, operating, and so you look at operating activities. Is he made money? So that is one thing you can easily get. Okay, company is making cash. The third thing you have to look at is the company paying tax? Because most of the company, they book very high profits, but they will not pay taxes. So that is one indicator for you that there's something wrong with the company. If a company is making so much of money, it's only logical that they have to pay. You and I earn income, we are paying taxes. So you look at only 2-3 fundamentals to begin with. Over a period of time, you will become masters. But I'm just saying, even to say that I don't understand finance is little far-fetched. You don't have to understand too much of finance. You just have to look at the basics of, is there a cash, is the company making profit? Is the company paying taxes? Is there a cash flow out of the operations of the company? 3 numbers you look at it, that is good enough, and that you don't require to look at. And how much most of the companies, what they do is that they book false sales. Debtors, they'll keep it very high. Revenue, they'll book it high. Debtors, they'll keep very high. And cash flows will be showing negative. So these are some of the things you can pick up. So fundamentally, it is like how you choose your bride or bridegroom for your children. The same thing is what you have to pick up for stocks. And today I'll tell you, knowledge has become commodity. I'll tell you this, knowledge has become extremely commodity. There's nothing which I know which you don't know, or somebody knows somebody else doesn't know. Today everybody is in the same place. The evolution of technology, what it has made knowledge commodity or information commodity. May not be knowledge, but information commodity. So information is available across. So what distinguishes between you and me or anybody A and B? Why is one A successful and why B is a failure? It's only fundamentals of execution. It's only fundamentals of execution. Knowledge, the same stock. That is why many times people go by, Rakesh Jhunjhunwala has bought this stock, so I will also buy this stock, which is fine. But when he is exiting and how much, at what time he is exiting, you don't know. He doesn't come and announce, I'm going to sell this stock tomorrow morning. He doesn't tell you that. So he will tell that I bought this stock, you go and buy that stock. But when he is going to sell, you will not know. The question is that comes fundamentally from your own psyche and what is your attitude. The biggest, one of the biggest failures I've seen in people who lose money in markets is not because of the market, it is because of themselves. It is a large part of the problem which comes in the market comes out of only 2 activities it comes out of. There is a fear and there is a greed. The fear factor is that when something goes, like in COVID also I was also petrified. The market fell by 30%. 2008 it happened. If I go back to history, 2007 from 20,000 index came down to 8,000 index it came down in a span of almost 3 to 4 months when the global financial crisis happened. So there are always pockets when the crisis happens. There is always a fear. It is easier said than done. It's easier to say that don't fear. When you see your money going down, it becomes very difficult. It's sometimes on podium to come and say, don't get scared, but it will be there. But over a period of time, you have a very calibrated approach. This is where I feel women do much better than men. Now I'm coming to, are women good investors or men good investors?
Women are
Why do you say that, ma'am?
balanced.
Huh?
Balanced and informed.
Exactly, this is the point. Women are far more, in fact, my daughter keeps telling me. In fact, for some period, even my wife beat me in the investment. So women by nature have 2 things which go in their favor. One, they are, their risk mitigants are very high. They will not take undue risk, they will not take. And the greed factor is also relatively less compared to men. I mean, I'm not trying to bring up gender bias. It's a study which has been done. Even women fund managers, historically, the number of women fund managers in the market is not very high. But nevertheless, the women fund managers, by and large, if you do a statistical study, you'll find that they've done relatively better. Because the fundamental thing of a woman is that she's risk averse, risk mitigant, and she will not take undue risk. I mean, by nature, there'll always be exceptions to it. So, the other mistake some people will do, which I think I start.
Yeah, we'll go in for a question and answer.
Okay, so I'll finish some of this. I had so much, you should give me 2 hours time here.
Yeah, I know.
So anyway, one of the fundamental things which women do is that, or even men do, is that they lose money in one stock, they like to make the money in the same stock. In fact, I had my elder brother, he lost money in his bank. I kept on telling him it's not a good bank, you should get out. However, he thinks his younger brother is working as a competitor bank, so he is not giving him correct information. So I've been telling him for a long time it's not a thing. But anyway, you can make money in Kotak Mahindra, I can make money in Yes Bank. That was his idea. It's fine, okay. I have no issues with that. But after that, at a point of time when the story came out that Yes Bank is gone, or at least thereabout, he knew that the writing was on the wall. What he does is that he goes and buys more. He wants to average. The problem is that averaging junk stock is the most cardinal mistake in the market. I'm not saying averaging a stock is bad. Averaging is a very good strategy for good stocks, but not for this junk stock. So people go because they want to make money in the same stock. I suppose forget about it. There are 8,000 stocks in the market. Why are 8,000 shares are there? Why are you running after one and two? Okay, one bad investment, it is fine. We have lost, but go ahead and use that money somewhere else and make. Never. And this I've seen with many people. Many people have this tendency. I betted on this horse, I'll win only on that horse. Please don't have that. If you have that conviction in the stock, is a different idea. You have a conviction in the stock and you know that there's ups and downs are there. I like to live with the downturn, but I'll make it up. It's a different story. But when you know that the stock is doing, I had a good friend of mine. He invested. Somebody from HDFC Bank came and told him SpiceJet at 80 rupees. He went and invested. I said, boss, why did you go? And 50 lakhs, not 50. He started with 20, 25. Then at 50 rupees he buys. Again he buys at 40. Again he buys. I said, what are you doing? No, Venkat. I did this with the Tata Motors. It worked for me. I said, Tata Motors and SpiceJet are not the same company. Why are you doing this? That's a Tata group. It had its own thing. So people feel that if I average, I will make money. It's not necessarily true. Largely, it depends again on the stock. The fundamentals of a company is extremely important for picking and choosing a stock. So, since Ramesh has given me the dictate to stop, I'll just give me 2 minutes time. If anything very important I missed out, just give me 2 minutes time. So, I told you about booking profits. The most important thing is that when you book profits, enjoy that profit. I still remember 90 I got married. I forgot the name of the stock. Some 8,000 or 10,000 rupees I made. I went and bought a refrigerator with that 10,000 rupees profit. So sometimes these small gestures, it's not a big kind of a thing. You have to feel that enjoyment happening. Buy a house, something in the house you can buy. So use that money and see the tangible value. Sometimes you should bring that correlation of the tangibility. Otherwise, you're making money, you're putting money, and then you're losing money, then you're gaining money, going this way. Then finally, somewhere that money should translate into asset, which you can feel and enjoy. So I would suggest that it's more not necessarily a tool to follow, but necessarily something you can enjoy about. Medium to long term, should I go through? So you can go through mutual fund. I'm just trying to one or two examples which you said. I'll take that. Promoters have spoken about. Booking profits, I said, junk average monthly salary profit. Okay, mostly finished. The other important thing is that this is another thing I normally do, which is again not relevant. When you are going gifting somebody for a marriage or for a birthday or something like that, instead of giving some gift, give some shares. Okay, so actually it will grow. It will actually very much help because this was the case. One of my colleague. I think she got married about 4 or 5 years back. I gifted her a MRF share. That time it was around 55,000 rupees. So for a long time, as I told you, shares don't go up. So when there was a spurt from 50 to 75 or 80, she called me. He said, sir, should I sell this? I said, no. I put one caveat. I said, you cannot sell the stock without informing me. That's my only condition. Rest of it is yours. This is yours. I'm not going to ask back from you. It is your stock, your share. But I'll tell you when you have to sell is my discretion. That's the only condition. She said fine. So after 3 years, after a spurt, it went up to some 60, 70. She called. I said no. Then again, around 90, 95 it came. Again she called me. I said no. Then what happened? It crossed 1 lakh 5,000. I called her. She said, no sir, I'm not going to sell. I'm going to give it to my doctor. So I said, this is what happens. Actually, the question is that these are some of the small things which will make a huge difference. These are growing assets. You can't go and buy a land and give. The beauty of stock is that you can even buy one share. MRF is an example, is a wrong example, 1 lakh share. There are a lot of stocks, one share at 800, 1000 rupees are there. You want to give 1000 rupees, give one share. I'm saying it will grow in thing, and that person will also remember. Hopefully they don't sell it, that's a different issue, but you can do that. So that's something you can do that. I think mostly I have covered whatever I wanted to say there. And the fundamental thing is that don't take concentrated risk. This is the most important. Most of the people buy one stock, two stocks, unless you are an expert. The example I gave of ITC was a compelling story for me after a long period of time. So even in my portfolio, I don't have one stock which dominates more than 5% or 6%. If you have 100 rupees, keep it in around 20 stocks or 10 stocks at least, and one stock should not be more than 10 to 12%. These are basic principles of risk management and things like that. So sometimes people, it's like one horse, I'll bet on this, I will make money. You are not, and the beauty in this market is that every day